Welcome to the first in the Banker's Leadership Series on infrastructure finance. I'm Neil Sen, a contributing editor at The Banker. In this roundtable discussion held at Financial Times headquarters, we will be examining the future of infrastructure finance. I'm joined by 5 guests who will introduce themselves to you, starting with the gentleman on my far left.
I am Olivier Delfour and I run the Global Infrastructure Group at Fitch Ratings.
My name is Martin Stanley. I'm an Executive Director at Macquarie here in London, and I'm responsible for the European infrastructure funds.
And on my right?
I'm Nick Bliss. I'm a partner at the international law firm Freshfields Brookhouse Derringer, and I head the Infrastructure and Transport Group.
My name is Andy Rose. I'm a board member at Partnerships UK. Partnerships UK was originally set up by Treasury and now is a public-private partnership itself, jointly owned by the public and private sectors. And we focus on PPP transactions and also other complex infrastructure procurements.
I'm Paul Davis. I'm a partner at PricewaterhouseCoopers in our public-private advisory team.
Now, we're seeing record levels of private sector investment in infrastructure at the moment. But do you think that in their enthusiasm to get into infrastructure, they're perhaps defining infrastructure a bit too broadly? Martin, how would you define infrastructure finance?
Look, I think there are 3 types of infrastructure. Let's start there. In our view, there's economic infrastructure, which are things like utilities that are essential for the development of an economy. Then there's things like social infrastructure that are there to ensure the well-being of the community. So things like, housing, healthcare, aged care, that sort of thing. And then there's commercial infrastructure that's been developed for commercial reasons predominantly, and is generally competitive. And those are the sort of 3 categories that we look at. And then in terms of the way that Macquarie will look at infrastructure, what we do is we say, in order to invest in infrastructure, it has to have 3 characteristics. The first is it has to be providing some kind of essential service to the community. Second thing is it's generally got long-term stable cash flows. And the third thing is it's generally got some kind of strategic competitive advantage, which usually means it's regulated either by competition authorities or by economic regulators.
Does anyone disagree with that strongly?
No, I think I'd certainly agree with that. For years, Macquarie have historically been known as defining or putting parameters around infrastructure as having a so-called privileged market position. As Martin says, very important to the functioning of a society and occupies either a monopolistic and therefore regulated by a regulator or quasi-monopolistic position, and therefore has the characteristics of throwing out these reasonably predictable or highly predictable long-term cash flows.
That's an interesting question. Olivier, do you think infrastructure finance should be seen as being low risk?
Well, infrastructure assets, I think, should be seen as being low risk, especially because the definition, I agree with your definition, but you hear a lot about now, expanding the definition of infrastructure, primarily for, say, marketing type reasons. I think we discussed that when we discussed the financing as well. So the core infrastructure sector, I think the assets are fundamentally sound most of the time. If a road was worth being built 6 months ago, it will be worth being used in 6 months, no matter what the financial markets are. What is a little bit less safe, especially in the recent days, I would say, is the financing of the infrastructure sector, the debt side, because obviously I'm much more focused on the debt side. So I would make the difference between the assets that are safe, sound, and resilient, and there for the long term, and the financing of these assets that didn't really match these characteristics. So I think there is a real distinction between both.
And it's also associated with moderate returns. Martin, would you agree?
Well, just pick on something that Olivier is saying. I think when you think about an infrastructure asset, the simplistic way of looking at it is it's a safe, secure asset. And I think there are lots of things that owners of infrastructure or purchasers of infrastructure can do to make them quite unsafe. One, of course, is paying too much for them and putting too much debt on an asset. And I think whatever the asset, that is a risk that you've got. So clearly, you've got to make sure you pay the right price for it, and you've got to make sure you manage it properly going forward. So I would just say that about the security and safeness of some of these assets.
Paul, is that broadly in line with the sort of advice you typically give your clients about when they're considering investing in infrastructure?
Yeah, absolutely. I mean, the first thing to differentiate infrastructure from, say, normal corporate lending, if you ask yourself the nature of those assets, will a particular company be in existence in 5 or 10 years' time? It's often quite a vexing credit question. Will a road still exist in 5 or 10 years? Question is a slam dunk answer. So the nature of what we're financing is there, and therefore there's long-term cash flow. The only danger, therefore, is if one takes too much advantage of those assets, overgears, and therefore creates short-term problems which are beyond being able to be sorted out. So yeah, in terms of are they great investments for the likes of the Macquarie funds? Absolutely. Are they highly competitive as a result? Yes, they are. Do they fit pension funds and the long-term liabilities that pension funds have? Yes, they do. So they're very attractive as long as they're done prudently.
Andy, why is infrastructure so important? Do you think it's now more important than it's ever been, perhaps? Or at least investments?
Well, I think it's very important. I think there are a couple of areas. I think the classification of it as infrastructure is largely around asset allocation from investors. And I think bringing private sector capital into infrastructure is a very good thing. I think another attractive feature of it is the stable cash flows that you talked about. I think from the public sector's point of view, it is bringing capital in that is delivering both infrastructure and also the related services to infrastructure. So Martin talked about social infrastructure, so things such as schools and education and hospitals and housing. And I think one of the great things from the public sector is it's attracting capital into a very important sector for government, not just in terms of the underlying assets, but also the related services that come alongside that.
The OECD recently published a report, Infrastructure to 2030, which highlighted your question was, is infrastructure important? I mean, that report said, yes, it is extraordinarily important. It is, as infrastructure really you could regard as being the bone and sinew of a working society, a working body. And basically that report highlighted the collateral advantages that infrastructure builds. If you build an airport, I was in Amsterdam yesterday. Schiphol Airport services the flower market. The flower market couldn't operate as it does in Holland without Schiphol Airport. But you know, the guys on the market don't actually pay fees. Indirectly they do, but they're indirect users of infrastructure, and that's what you find with infrastructure. It's the bones and sinews of a country. The OECD report highlighted these collateral benefits that infrastructure builds and the importance of infrastructure, and also highlighted the infrastructure sort of funding shortfall, effectively, that nation states aren't going to be able to afford all the infrastructure they require, either in the developed OECD countries or the non-OECD countries, and basically said, and how they got to this, I don't know, that we required investment of between 53 and 70 trillion dollars or something between now and 2030 in infrastructure globally. So it is very important, and we need a lot of it, and it's almost like health expenditure. It seems to be the more you have, the more you need. You know, it's sort of some sort of exponential curve in there.
Just a point there. Nick highlights one key thing, which is for so much of infrastructure, the people that benefit aren't necessarily either the users or people that pay for it. And that creates an issue for government to think about. So how do you actually create the revenue so that these things can get built and investors can be interested? The result of that is it tends to get prioritised a lot of the times where that's easy to solve. So, for instance, toll roads is the classic example where they have come in advance of other parts of the infrastructure market because it's quite clear you can raise tolls and therefore finance the road on the back of it. Much harder to find a revenue source for a school or a hospital, and clearly that needs direct government intervention to create a model that creates the revenue against which then the infrastructure can be financed.
What's really interesting when you talk about, you know, infrastructure today is generally sort of focusing on assets that are already in existence that are being acquired through an auction process, and lots of infrastructure funds going out and buying these things. But actually what the OECD report is talking about is the need for new infrastructure and the need for this huge investment in OECD countries for the development of either existing assets or new assets. And just if you look at electricity supply in Europe, I think the number they're talking about up to 2025 is something like $10 trillion of infrastructure in electricity supply, both generation and distribution supply. And that's a huge amount of money. And yet, infrastructure providers or infrastructure managers are generally at this stage just focusing on acquiring existing assets as opposed to this sort of new area. And when you look at government funding for infrastructure has fallen from, I think it was something like 9.5% in 1995 down to 7.5% in 2005. So there's a big gap emerging. There's a big demand for new infrastructure, and there's a reluctance or an increasing reluctance on the side of government to be able to fund that. So the private sector's got to step in, and the mechanisms have got to be there to allow the private sector to step in to make that happen.